Then today we'll discuss about the waterfall model. Okay. So in a private equity, yes, exactly. In a private equity, you can see this is the waterfall capital distribution activity, or maybe you can see this activity for the carried interest distribution, or you can say the profit distribution, right? Or maybe you can see this activity for to return the capital to the investors. And that is what this is like, the key function that you can see in a private equity business. And at a process level, while processing the transactions, also this is very important that you should know how the waterfall model work, how the framework is about the waterfall distribution or waterfall capital distribution in a private equity business. We should know it. So this is for like to calculate the contributions of investors and contributions of general partners, and accordingly you can initiate the return of capital process in the private equity firm, right? Because even in the last sessions or previous sessions, we discuss a lot about the limited partners contributions, general partners contributions, right? Okay, so this is for like investors, and this is for the managers or hedge fund, sorry, the P managers who are actually managing the funds, right? And while distributing the benefits or capitals, how can you distribute it? And in even in a private equity that already I mentioned, this works in two ways, like whether you can invest in a preference equity preference equity segment or else bonds, right? Because we don't provide loans in a private equity segment, you cannot provide loans. And if you can provide loans, then you shouldn't be there. There would be definitely banks who can provide loans, or non-banking financial institutions. They can provide loan facility to the businesses. But they cannot, just because of private equity is there. Why they cannot? Because if the business is generating the loss only, then how can you provide the loans facility to the business? Because when you talk about banks, they have a one more parameter, which is credit worthiness. If the and you're making losses, then definitely you won't have any credit worthiness or credit report or credit history with you. All right, that is what. So it means you have only two options, which is one, you can create a bonds, or else bonds you can say like notes, and you can issue to the limited partners. Okay, so this is from a issuer side something. Okay, but we are talking about here the private equity house side, how they can initiate the capital distribution process or return of capital. Here that word you can see like the structure for capital distribution. Okay, so one important point that want to mhm, here. Okay, so what about this preferred return? Even in the interview, also most of the time, you can see questions on this preferred return. What is this preferred return? How you can calculate? What is this catch-up? And what is this carried out? And what is the final distribution? It's very simple. When you invest or when you pooled capital from the limited partners, this capital will have a period. So it could be 5 years, it could be 10 years, or it could be 20. Depends on the agreement between the general partners and limited partners. Right? Suppose you are a general partners and I am a limited partners, and you are asking me to fund to the XYZ business. Definitely, I'll ask this for how many years that you are looking for a capital from my side, right? You're saying that 5 years. Okay, so in this example also we'll consider 5 years because 5 years is very decent period. More than that, it will like sometime it will take more than that to convert that deal into a profitable business, right? And then you can sell out your entire stake to the mutual fund and hedge fund business at the time of listing, and then you can exit. But let's say the duration is 5 years, right? But the point is, suppose I have contributed 1 lakh, and that is for 5 years. 5 years. Let's assume it at the time of signing or developing the agreement between you and me. Definitely, I'll put some restrictions, right? Because in terms of return, how you gonna be provide a return on my investment? Correct? How you gonna be calculated or how you gonna be provide that return on my investment? I want clarification. So you said like yes, we can provide that the 8% preferred return for per years on your contributed or invested capital, and this is on the basis of cumulative basis. So this might confuse you. Cumulative, it means we'll calculate it how it's work, right? 1 lakh as a preferred return on the invested fund, and that is on a cumulative basis, and it will carried out till the 5 years. Okay, so again, so we'll do calculations. Let's see how it's work. Invested capital by the LPs. Okay, so what is the investor capital? 1 lakh. Preferred return. Why we are saying preferred returns? Because actually we have invested into preference equity, right? So there will be a preferred return as well. And the 8% that is minimum. Even you can sign for more than that as well if you find any strong, business or startups. So in that case, you can commit more return as well. It depends on the agreement between limited partners and general partners, not the issuers or originators of the business or promoter of the business. Okay, so now years. First years, like again, for first years, you can't earn anything because this is just like investment year. But at the end of the year, you can calculate it, right? Because suppose today you have invested 1 lakh, so you can calculate this at the end of the year once the 1 year will complete, right? So let's say this is we are ending with the 2021, 2022, 2023, 2024, 2025. Okay, and this is cumulative Pref return plus invested uh, invested capital or principal that you can call. Okay, okay, this is important. So now we'll calculate it. The investment will remain same till the 2025. Even the preferred returns will be remain same, that is 8%, right? That is like, see, cumulative, it means it is just like committed returns on the investment, right? So what will change, that we'll also discuss that as well. But this is like very important. On the agreement also, you can see the same terms and conditions because I have already gone through this entire documentation part for a private equity process. Since last, I think since last 6 months, I have gone through a number of agreements. Okay, so for first years, we'll calculate the returns amount into 8% divided by 100. So on which you can earn. So now you can do this calculation. Okay. So for a first year, once you complete 2021, so it will have, as an investor, think from a limited partner side, it will have a 1,08,000 as your total capital, and the return would be like 8,000, right? Ha. And suppose if the general partners, they want to initiate a refund or return your capital or sell this capital to someone else, because sometime what happened, suppose you don't want to carry it out with this particular business or particular fund, you can insist or approach for a refund of capital, or else you can sell out that capital to someone else who is interested into the same business line, right? This happened, and that is what the business is going on, this private equity business going on, right? On every quarter you can see some new investors, and on every quarter you can see some old investor also will exit from that particular private equity fund. Okay, and that is what we create a pool. So once you create a pool, it means your investment goals, whatever investment goals that you have, it won't affect. So your business must go on, and in the pool that you can see this n number of activities: buy, sell, buy, sell, buy, sell, buy, sell. Okay. So second year, once the second year will reach, so here will. Hmm, okay, just a minute. Sometime it happened, it go on ideal situation. Now can you see my Excel? Okay. So here, so there are, this is like return, right? 8% on your invested capital, and that is 8,000. And once you return plus your capital would be goes around 1,08,000. But suppose now we are completed 2022 as well, right? So here that we are calculating the return. So how can we calculate then? Definite, yeah, exactly. What happened? 1,08,000 into, yes, now. And now, So your total return of capital would be 1,16,640. This is important. Again, if we calculate the same way, 8%, you're getting me right? How I'm calculating, because there also, suppose if you place for this particular process, then you will have to calculate the same. That is what. Mm, yes, exactly, exactly. Sometime, okay, because you should know each and everything. You can you can check the agreement between the limited partners and general partners, and then accordingly you can initiate the process. Mm-hmm. Xavier is the private limited company. See, private equity. What is the meaning of private equity? Private equity, it means it's a private fund invested in a private limited companies. Simple. So it can be. That's fine. The last one would be this plus 8%, and when we total, okay, so we are here now. Suppose, let's say today we have completed 2025 as well. So now this is the time where we'll have to return the capital or initiate the return the capital process to the limited partners, right? So we'll have to return this capital, correct? This one. First of all, we'll see. Okay, one more point. Total invested, because there are two to three terms that you can see, so it will help to even understand those terms as well. Total invested value. Total invested value, it means suppose you had invested in XYZ companies and now the value of that investment is around, let's say, 2 lakh. Hmm? And as per the agreement, okay, first of all, we'll have to recover the invested capital first from the total value of a business. Correct? What is the total invested capital along with the preferred return? That is 1.6. Okay, I'll calculate it. So from 2 lakh investment value, we'll return this first. And how we gonna do this? Because as I mentioned, once the company announced the IPO, in that duration, they will have to calculate their valuations of the business and they will have to initiate the refund procedures for the private or else private equity owners or HNI investors, they sell out their stake to the hedge fund houses, general public, or even hedge fund houses and mutual fund businesses as well, right? So once they sell out, it means definitely they will receive some remuneration or consideration. And let's say there's the consideration is around this 2 lakhs. They have even written this the committed capital plus preference return or preferred return to the limited partners. And now they are remaining with this amount, remaining balance. What they gonna do with this remaining balance? Any idea? Because we haven't charged 20% as well. Because as a PE house, they will charge some charges, right? Hello, Rahul. Hello, Rahul. I can't hear you. Hello, Waterfall. Hello, Rahul. Hello. What happened to him? Rahul? Okay. Okay, okay, no problem. Guys will have to stop their hand. Okay. Invested, total invested value, remaining balance. So, okay. So now you win. Okay. Okay. That's it. Okay. So this amount again. So once you return this, the invested amount by the limited partners, you have a remaining balance around 53,000. Correct? Then what you gonna be do with this particular balance? Because till time even you didn't charge the performance fees or management fees, right? Till time you didn't charge. Okay. Then what you gonna be do? Any idea? Any guess? Yes, the proper term should be like catch-up call or catch-up, you can say. Catch-up, it means then we will charge 20% on that particular amount. So we'll charge 20%. Let's see again. So what would be the remaining balance? Remaining balance after catch-up paid. 20%. So this is your management fees, and we'll do the calculation for this. Okay, so now you see the remaining balance again up to spelled, did I wrongly spelled CAT catch up. Okay, so this is you again, you have a remaining balance up to paying the performance fees or management fees or blah blah other things. You have a remaining balance. Then again, so there would be a questions what you gonna be do with this particular remaining balance after catch up paid. So here, so most of the prominent terms that you can covered in this waterfall model or waterfall distribution in private equity business. Okay, so here again, so one more important concept or terms that you can see which is carried out interest. Interest, or else you can say like profit sharing. Profit sharing on a remaining balance. So here again, so 20% goes to general partners and 80% goes to limited partners. So you can split this value into 20 and into 80. This value into 20 divided by 100 and the rest. Okay, so this is your carried interest for both limited partners and general partners. And even on the document itself, you can see the same terms and conditions, same framework that you can see or read on the document as well or on the agreement as well, right? Yes, 43. Why I have calculated? Okay, first of all, yeah, you go ahead. Yeah, even you can see the total, you can see the total would be 43,098, 43,098. See, this is a remaining balance. It means okay. So you have written the capital, you have written the preferred return as well, right? Even you have written everything. So now still you see the balance after charging or deducting the catch-up call or the management fees. I would say you see the again remaining balance in the same account. Then what you gonna be do that particular balance? Definitely, it will have to distribute that between the limited partners and the general partners, correct? And the same way we have distributed, and here that this entire agreement or this particular investment goes to end procedure, because once you return this carried interest amount as well, then there is nothing would be remain in the same account to return or to distribute between the limited partners and general partners. So end would be like you can close this deal. This word would be the proper word where you can see, or you can like discharge the agreement between the two counterparts, and you can just clear it, done and dusted. This is how this waterfall model works. So we should know the calculations as well, because in the system I'm not sure whether there would be any robust system which will help us to calculate each and everything in a very proper way. Okay, and sometime or with the some organizations you can see such a manual task as well, and that is what they prefer the candidate like uh, who is from the CA or CFA and all, right? Who have a hands on a calculation part especially. And even so, this is the model that you can see how it's work and all. This is the period. Okay, I don't want to, so I'll just draw it. I have just developed this model for like 1 year. Sorry, for 5 years. Okay, one, two, three, four, 5. This is a limited partners capital principal, right? See the way the capital has been increased. One here that you can see the addition somehow. Here you can see the addition somehow. Here again you can see the addition, right? And for a distribution also you can see the distribution. So distributed, we have distributed the capital. This one between limited partners and general partners, right? Even you can see the term like internal rate of return, I IRR. Internal rate of return, it means the return which you have earned on your investment. Because in the private equity business, what we do generally, see this, we invest in a multiple companies, right? And how we initiate this process, suppose in the first year, this E company been matured, and even they have returned everything to us, and this entire amount is in the P account now. Then we'll have to initiate the capital distribution or return of capital process. Suppose very next year you see this even D company also has been matured, even C company, B company, and D. And the same way you can even execute or distribute the capital to the new businesses as well. But this is again depends on the investors. If investor want to invest in the another business, they can sign or renew the same agreement, right, with us, or else we'll have to return to it and we'll have to find a new investors. But from accounting point of view, private equity accounting point of view, so this waterfall model is plays very significant role, because every time, every year, every quarter, every month we'll have to mention this counterparty's name or this investor's data into our books of account or into the private equity funds books of account, and even in the same the investors account as well, because as I mentioned, every time we'll have to prepare two books of account for a general partners and for a investors as well, right? And whatever will do the accounting entries in the books of investors, it will exactly will opposite in the general partners, or I would say the private equity books of account, right? The for example, the return of capital, ROC, we are returning the capital to the investors. Investor actually receiving something, and the PA house paying something. or returning something, right? So they're like the debit would be the cash is coming into their business. So they will mention that the investors in the books of investor will be like cash at debit, and who is the given? The private equity given to it. So private equity would be credit, right? So this is how this entire, we'll see that the accounting entries, as the point is, so you can link such things to the accounting perspective as well. So you should know this procedure, because this is like ongoing activity, and that is what accounting come into picture. This is not like one time activity. At one time investor is investing in the private equity business for next 100 years. So in that case, even you don't need to do the accounting as well. So once you return or start to initiate the return of capital procedure, there you can see the accounting. So it means there you can calculate the profit and loss, right? Till time you don't need to prepare the accounting, you can just prepare the cash flows, you can see the negative and positive balance, and you can carry out your entire activities. Because why we prepare the accounting, the main reason is to calculate net profit and loss. That is how we prepare the accounting, right? Otherwise there is no need to prepare the accounting, because when you earn loss, again you don't need to pay the tax, and when you earn profit you need to pay the tax. Am I right? Okay, so at what point you're getting confused? Okay, so I'm saying that why we prepare the accounting, or why we need to prepare the balance sheet, why we need to prepare the profit and loss account. What is the reason behind it? Ultimately, we should know what we have earned through this business activity. Correct? What is the intent? To calculate the net profit and net loss. And how are you going to calculate it? When you maintain this record transparently. Transparency is very important. Right? Return of capital, in then invested capital, right? Then other expenditures, whatever that you have received, maybe employee salaries, maybe light bill, maybe infrastructure, everything that we need to record in the books of account, and on the basis of that you can calculate your net profit and net losses. I'll show you the that statement as well, where you can see it, because once we touch to the entries, then I can show you the private equity reporting template as well. There you can see how the investment looks like. There you can see from a P house, private equity house, how you gonna be prepare the financial statement or the financial reporting. Okay. So the main point is, so most of the time you would have a questions how we prepare the financial accounting and all. So we should know that our investment, we should know our return of capital. This investment, it means this invested. Return of capital from the again the companies, invested companies, right? Return of capital to the investors. Remaining balance in the accounts of P. Sometime you can see the word like the dry powder as well. Yes, so here you can see the dry powders. Leveraged cash. This cash is still in the books of account, and that is in a liquid form. So you can anytime invest into other business. Means the cash is in the ready form to invest. Dry, it means that you haven't invested. That's it. Okay. Okay, so now you can ask your doubts about these terms, because this template I'll also forward to you. First of all, you read it, and then again if you want some clarifications, we'll discuss this part as well. But the way I have calculated, you can calculate in this way. This is like, see, when you look to this template, it will take lots of time to understand it, how it. I have calculated and all, right? But this is like simply that I have calculated in front of you how you can make the calculations, right? Yes. Meaning is like for catch up that you can say it is just like fees that we guys are. See, these are the words that you can see in the agreement, first of all. Okay. And if I'll, in the diagram, looks like, uh, there was something, but I think here that we can draw diagram. Diagram in the sense like how it's look like. So I'm not good at. This is invested fund, right? And now you're going to initiate for a refund or return of capital, correct? So first of all, you will target to the invested capital. So it means this this level first of all will have to return to the capital first, and then if you see the balance in the accounts, then definitely you will try to return this investment with the along with the preferred return. And if you see again the remaining balance in the account of that particular P, then you will try to schedule a catch up. This is for like P house or the managers who is going to manage that particular fund. And if you see again the remaining balance, then here that you can find this catch up. Sorry, here that you can see the catch up for a 20% that you're going to charge, and here that you can find the carried interest 20 and 80. This is not a even 20/80 like, but yes, this is like standard ratio that I would say, but it can change, and this is fully depends on the counterparts how they want to distribute the remaining balance between limited partners and general partners. It could be 40/60, it could be 50/50, depends on them. This is how it looks like. Okay. But yes, the terms and the names, those are like important. Return of capital, preferred return, catch up, carried interest, final distribution. And if you get a chance to work with the reporting team, definitely you can see such words. And in the system as well, suppose you are a part of like payment processing or wire payment, recon, or maybe the other trade processing and all, or cash processing, or treasury management, or blah blah things, you can see the same names. Return of capital, it means we'll have to record in our books of account when we return the capital to the investors. And suppose that the XYZ investors, they have tied up with us and we are entitled to provide accounting services to the same investors, then we'll have to ensure that as well. So it means we'll have to look the both the books of account at the same time and perform the recon as well, right? Don't worry about it if you're not able to understand. First of all, focus on this. This is waterfall distribution. Okay. And if you are able to understand this waterfall distribution, definitely you can link entire things to each other without my help. Okay. Okay. So I'll forward this it to you. So see if you get any PA template. And I think I should forward the security purchase agreement as well, so you can look to that also. Private equity. Okay, so do you have any questions so far in this particular waterfall model or in a private equity? Because there are again uh, new concept also you can see, but these are like common and I would say the important, uh, you know, content that you can find in the private equity business, right? Because apart from that, there would be some new names also would be there in the system or on the agreement as well. But when you find a meaning, you can relate to this only. Like so, that is what these are important words. There is no alternative to these words in the private equity business. So, like catch-up call, commitment call, right? Drawn down, roll over. So many a number of new words also that you can see. But those are like similar to this, where you can relate to maybe to catch up, maybe to remaining balance, maybe to invested value, maybe to return of capital, maybe to cumulative benefit or preference return. So that you can link to it. Okay. So I'll first of all